All right, let's talk about Build-A-Bear. They just posted a record-breaking year, so you'd think the stock would be flying high, right? Well, not exactly. In fact, it had a pretty terrible day. So what happened? We're going to dive into this classic Wall Street puzzle, and believe me, all the clues are right there in the earnings call.
So picture this. It's the morning of March 12th. The earnings numbers drop, and things are looking fantastic. In pre-market, the stock just rockets up, over 8%. But then something changes. By the end of the day, it's not just that the gains are gone. The stock is actually down more than 4%. I mean, that is a wild 12-point swing in just a few hours.
So yeah, what gives? You got to ask, how does a company put up record numbers for the whole year and still see its stock get totally hammered? That's the big mystery we're unpacking here. And the answer you'll see is all about this tug of war between a really great past and let's just say, a very cloudy future.
Okay, so to really get why the market had such a massive change of heart, we've got to start with the numbers that kicked everything off. And yeah, while the full year picture was great, if you zoom in on just the most recent quarter, Q4, that's where you start to see some cracks appearing.
Now, looking at this, you might think, what's the big deal? I mean, earnings per share was off by just 2 cents. Revenue was shy by less than $2 million. It seems pretty minor, right? Well, on Wall Street, even tiny cracks like these are all it takes for the bears to start smelling blood in the water.
And if you dig just a little deeper, you find out why they missed. Their profitability in Q4 got squeezed from both sides. First, they took a $6 million hit from tariffs. Ouch. And second, their gross margin dropped by 1.4%, what analysts call 140 basis points. The bottom line is, it was just getting more expensive for them to make and sell their products.
Okay, but that's just one side of the story, the bear case. To understand why the stock jumped 8% before the market even opened, we have to look at the story that management was telling. And honestly, it was a pretty compelling story, all about a record year and a really solid plan for the future.
And for the full year, man, Build-A-Bear absolutely crushed it. We're talking record revenue. They broke $500 million for the first time ever. Record earnings per share, they pushed into 8 new countries, and they did it using this really smart asset-light model, which means they don't have to spend a ton of cash to grow. Oh, and they also gave back almost $40 million to shareholders through buybacks and dividends. This is the story that had the bulls all fired up in the morning.
And you can hear it straight from the outgoing CEO, Sharon Price John. She basically said, look, it was a dynamic year, but we stayed focused on our strategy, and we delivered a solid year. Her message was super clear. Yeah, there were challenges, but we handled them, we executed our plan, and we won. This is Management 101, setting the tone, pointing everyone to the big picture victories.
And to top it all off, they also reinforced this idea of stability by laying out a super smooth CEO succession plan. Sharon Price John is retiring, and Chris Hurt, who's been the COO for a long time, is stepping up. Now, the market saw this and didn't panic. This wasn't some dramatic shakeup. It was a clear signal of continuity. Basically, the strategy that's been working so well, it's going to continue.
So, with all this good news, right? The record year, the solid strategy, the smooth leadership change, why the massive, brutal reversal? Well, it's because once the market had time to really dig into the earnings call, specifically the guidance for the next year, a totally different and frankly, much more concerning story started to emerge. And it all came down to one word: margins. Now, for anyone who's not deep in the finance world, margin compression is a huge red flag for investors. All it means is that your costs are growing faster than your sales, and they're starting to eat away at your profits. Think about it. You can be selling more and more stuff, but if your margins are shrinking, your actual take-home profit can actually go down. And that is precisely what the market started to get spooked about with Build-A-Bear.
And here it is. This was the bombshell number buried in the guidance for next year. Management basically told Wall Street to brace for a, wait for it, $16 million hit from tariffs. $16 million! That is a massive cost headwind. It's so big that it threatens to completely wipe out any benefit they might get from growing their sales.
And you can almost see the market's thinking play out in real time. That morning excitement over the awesome 2025 results, it just evaporated and turned into alarm over the 2026 forecast. You have this $16 million cost problem, which leads management to say that pre-tax income next year will be flat or maybe even down. And what do investors do? They immediately punch those new lower numbers into their spreadsheets, their models spit out a lower stock price, and boom, the selling starts. The bull case was dead, at least for that day.
So where does all this leave us as investors?
Let's pull everything together, look at both the bull and the bear arguments, and try to figure out what's next for Build-A-Bear.
This really is the perfect picture of the tug of war that's happening with this stock. On one side, you have the bulls, and they're not wrong. This is a totally transformed company. It's driven by its own intellectual property. It has a brilliant global growth plan that doesn't cost a ton of money. But then you have the bears pulling on the other end of the rope, and they're right too. In the short term, that awesome growth story is basically being suffocated by this huge margin pressure from tariffs.
So because of this standoff, we're giving it a rating of market perform. Look, the company's long-term strategy is solid and the brand is still strong, but that $16 million tariff problem, it's just too big to ignore right now. We think the stock is probably going to trade pretty much in line with the rest of the market until we get a clear picture of how they're going to solve that margin problem.
Okay, so now for our trade idea. And here's the kind of outrageous but totally plausible pitch. Right now, the market has completely priced in the worst-case scenario. That entire $16 million tariff hit, it's already baked into the stock price. And that creates a really interesting, what we call an asymmetric opportunity. What that means is if any good news comes out, maybe a change in trade policy, maybe they find a cheaper way to source their products, anything, the stock could just skyrocket as that big cloud of bad news disappears. The downside feels known, but the potential upside on any little bit of good news could be huge.
So that's the bottom line here. Build-A-Bear is a classic story of a great long-term plan hitting a really tough short-term roadblock. And right now, the market is laser-focused on those storm clouds on the horizon, not the sunshine they just came from. Remember, this is not financial advice.